Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax regulations to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in Washington, D.C. at PwC's Policy on Demand studio, where I'm excited to have Rebecca Lee back on the podcast. Rebecca hardly needs an introduction to this podcast, but she's an international tax principal in PwC's Washington National Tax Services Group, specializing in financial transactions and digital assets. Rebecca, welcome to the podcast.
Hey, Doug. Thank you for having me.
I sometimes describe you as doing all the areas of tax law and international tax law that nobody else really wants to do.
I built practice around it.
It's a great business model. I admire it. I admire it. And I also will say, before we dive into these 987 regs, that I get more nervous for your podcast with you than any others. And mostly it has to do with the technical material and not you personally, just FYI.
I appreciate that. Thank you.
You're welcome. All right. Well, I like to, you know how this game works. I like to start off with an icebreaker. I'm like hooked on a new streaming show. And before I share that, wanted to know, anything you've been watching recently? We're a little past the hour, quite a bit past the holidays at this point, but favorite new show or recommendation for listeners?
It's not necessarily new, but they have a new season coming out. The show Taskmaster.
Okay.
It's a UK-based show, and it's a quiz show where they have 5 comedians on, and they run them through a series of challenges. They're coming up on season 19. I discovered them over the break, and so we started at season 1. And have been watching them serially, and it's franchised all over the world. So there's like Taskmaster, New Zealand and Australia and Indonesia and so on, as well as a junior Taskmaster, which I've watched with my son. And so it's really, really fun.
I have to check that out. That's right in my wheelhouse. There's a lot of shows that just start in the UK. It's amazing. Kudos to for our UK listeners and how much of that TV ends up in the US and elsewhere around the globe for that matter. I assume this has nothing to do with Simon Cowell or Cowell.
No, this is they syndicate the show out on Simon Cowell.
Okay, thank you.
No, this is the brainchild of a guy named Alex Horn, and it's really funny. They now they have their own app, so you can watch all the shows in one spot.
All right. Mine is, and you may have seen it because I'm always usually a little late to the party, is AP Bio.
Love that show.
Love that show. It's Michael Patrick O'Brien, former Saturday Night Live writer, and I think he was a performer for a few years, but really takes me back to my advanced placement high school days, and it is just a really funny show.
I like it because it has Patton Oswalt on it, and Patton Oswalt is a William & Mary alum. Graduated a few years before I did.
Very nice. Okay, well, we're not going to turn this into a TV review show as much as it's interesting. Maybe compared to the 987 regs, but let's dive in. And I guess maybe before we dive in, can you remind our listeners, and you've been through this a number of times on the podcast, but what is Code Section 987? Why does it exist?
So in relevant part for today's discussion, 987 is the code section that tells you where you have operations that are run in branch format, or in today's world also in the form of a disregarded entity, that's permitted to adopt a different functional currency than its owner. 987 tells you the currency in which it calculates its income deduction gain or loss, which is in its functional currency, and then provides rules, or the statute directs the secretary to provide regulations on how those items create ordinary gain or loss from translation differences from when the income or the assets were acquired or earned versus when they are distributed or remitted from the branch.
All right. So we recently got a set of final regulations as well as some proposed regulations. We're going to start for the final regulations, but I will remind listeners and encourage them, if they have the heart to do it, to revisit our podcast from late 2023. Doesn't really feel like that long ago, covering the proposed regulations, and we're going to be discussing the regulations that were finalized here in 2024. We're also going to go through some of the technical mechanics, but we're also going to talk a little bit, spend a few minutes on some of the accounting implications of these new rules. So let's start with methods for calculating Section 987 gain or loss. If you can kind of remind us of the default and a couple of the elections and also maybe a little bit of context, because this has certainly been a moving target for almost 30 years now.
Yeah, I mean, this is the first time since we are now past, for many calendar year taxpayers, the effective date. This is the first time we have had final and currently effective 987 regulations since enactment in 1986.
So in our entire careers, about 25 years or so. Wow. Yeah, that's right.
It's a big deal.
Yeah, it's a big deal.
And so the 2024 finalized regulations largely retain the structure, mechanics, and general rules of the 2023 proposed regulations, which means to calculate your branch gain or loss that's recognized on remittances, the baseline or default method is something that's referred to as the FEEP method, the foreign exchange exposure pool method, which that's adorable, right?
I know. I feel like they could have done better on the acronym.
It's FEEP. It's a little FEEP.
All right. It's like PEEPs, like the.
That's exactly.
Got it. Okay. It's growing on me.
See? Yeah. And so what it does is it breaks the world into essentially monetary assets and non-monetary assets. And so your monetary assets, think debt instruments, accounts payable, accounts receivable, that are denominated in the functional currency of the branch. Those are remeasured on an annual basis, which actually looks a lot like what financial accounting does. And things that are non-monetary assets, plant, equipment, intangibles, goodwill, those assets are all held at their historic rate. And so the functional equivalent or the impact of that methodology is that you have foreign currency gain or loss on things that, had you held them directly, would have produced transactional gain or loss under our foreign currency rules. And that's the default. Mm-hmm. But the 2023 regs proposed and the 2024 regulations finalized an ability to elect out onto a method which is referred to as the current rate election, which produces a result that's quite similar to the 1991 proposed regulation. So it creates foreign currency gain or loss on everything, your foreign currency denominated loans and your plant and equipment and everything else, all of the activities.
Which is how we learned it.
That's exactly, that was the rule. And arguably what's in the legislative history. So the concept is they allow you to elect out, and there are some limitations that come with making that election. The 2023 regs proposed and the 2024 regulations finalized an annual remittance election as well. So if you don't want to keep track of pools year on year on year, you're allowed to elect to recognize all of your unrealized 987 gain or loss on an annual basis.
Are there specific, can you go back and forth? Is there consistency? How does these elections work?
These are treated a lot like accounting methods, and we could have a debate about whether they are accounting methods, but you make an initial election or an adoption, and then you can change, but once you've changed, you have to run out a 60-month period before you can change again. And this is an area, frankly, a lot of our folks that we work with are struggling a little bit, because you're going to make this initial determination. You're going to elect a method for the first period in which this is relevant for you. And so folks are really feeling a lot of pressure to make a good choice, because they feel like they're going to be stuck with it.
All right. And then sort of along the same lines, there are, similar lines, transition rules. So talk like, why do we need transition rules? And then what are those transition rules?
This is an area of the regs where I think IRS and Treasury were incredibly mindful of the fact that we've had 30 plus years of no finalized regulations and a diversity of practice amongst taxpayers. And so they divide the world really into the pre-effective date period or the pre-transition period and then post-transition. And what they have you do is essentially calculate whatever your unrealized 987 gain or loss is from the formation of the branch until the date of transition. And they have very detailed rules that tell you how to calculate that if you've adopted an eligible method, and then how to calculate that if you haven't adopted a method, or if you've adopted a method, but it's not an eligible method. That number becomes your pre-transition gain or loss. It's not triggered at the time of transition, so when the final regs become applicable to you, but instead becomes carried forward. So pre-transition gains just go into your net accumulated 987 gain or loss determination for when remittances are made post-transition. And if you have pre-transition losses, which honestly many taxpayers have very significant pre-transition losses, those losses become suspended losses, which are subject to a whole host of rules that govern when they can be recognized.
Okay, and we're gonna dive a little.
We will dive into detail on those.
Maybe before we get into some of the specific details, since we have talked about the transition and the various methods, what are the applicability dates? Because I think that's probably the most common question, right? Of like, when does this apply? What do I? Because this is, I mean, we've been getting this question: when do I actually really need to follow these rules? And now we've got final regs. When do taxpayers really need to follow?
Like, when do you really need to do this?
Yeah, is this for real this time?
This is. We'll come back and talk about the new administration, but in general, this is for real.
Yeah.
So the effective date or the applicability date are for taxable years beginning on or after December 31st, 2024. So if you're a calendar year taxpayer, that means that these regulations became applicable on 1/1/25, the beginning of your taxable year, with a caveat or an asterisk, which is if you had a branch termination after November 9th, 2023, these regulations are just a little bit retroactive because they apply to any branch termination or any election, think check the box elections, made after November 9th, 2023, even if the effect of it is a branch termination prior to that date. That's the date that the proposed regulations were released. And so you are required to apply the final regs to that QBU on the date it terminated as if those regs applied immediately before termination.
Got it. All right, so into some a little bit more of the nitty gritty.
That wasn't nitty gritty enough for you?
Yeah, well, we're going to get nitty grittier. Is that work?
Grittier.
Okay. Treatment of section 988 transactions within a 987 QB. So we've got two code sections. By the way, I will mention, I think the last one of these we did, we said no code sections.
It was so good.
It was so, I mean, I think for the record, I won. I had no code section references and you had one, but I will acknowledge that you spoke 96% of the time and I only spoke 4%, but fair enough.
And
but
the code section was 987, by the way.
That you had
said.
So maybe just for some of our non-US listeners and people aren't as detailed with this, what is 988? You've already explained what 987 is, and then we can talk about how 988 is impacted by 987.
So 988 transactions or 988 gain or loss, that's transactional foreign currency gain or loss. So what's recognized when you have a partial or complete repayment of a foreign currency denominated loan, an account payable, account receivable. And so our rules distinguish between translational gain or loss when you sort of have an entity who's permitted to operate in that functional currency and they make distributions or remittances. That's our 987. Versus when I have transactions that are not in my functional currency and I realize gain or loss with respect to each individual transaction. So
an issue where you could have 988 within a 987 if you haven't checked the box or a real branch, or probably more likely a check the box entity that legally owns has a receivable, for example, in a non-functional currency, a repayment of that could trigger 988.
Exactly.
How do these rules work now when you trigger a potential 988 transaction in the context of 987?
So this is a great example of where there was a rule that was proposed. It actually predates the 2023 regulations. But it was a bit of a sleeper because it was part of a proposed reg package that kind of didn't go anywhere. And as part of the 23 regulations was kind of re-proposed. There was this proposed reg that said that you make the determination of whether a transaction gives rise to transactional foreign currency gain or loss at the branch level, but then you calculate it by reference to the owner's functional currency. So a very simple example. I have a US dollar functional foreign corporation. It owns a branch that uses euro as its functional currency. That branch owns a pound-denominated debt instrument. Step one, is it a foreign currency transactional kind of exposure at the branch level? Yes, it's pound-denominated in a euro QBU. But then I run the calculation, at least as proposed, comparing the pound rate against the dollar rate, the functional currency of the owner. This is a calculation that exists nowhere.
Right.
No one would run this calculation. It doesn't exist for book or any other local tax. And so there were substantial comments submitted that this is just unadministrable and it's not achieving any policy goal because the amount ought to shake out to be relatively similar as combining the 987 and the 988 together. And so Treasury and the IRS took into account these comments and reversed the rule. So now foreign currency gain or loss at the branch level is calculated, both determined and calculated based on the branch's functional currency. So in our simplified example, comparing pound rates against euro and not involving the US dollar at all, which is now going to align with what the local entity sees for local stat purposes, local GAAP, It also has an indirect benefit if you're thinking about this from a Pillar 2 lens, that the U.S. tax rules, the U.S. GAAP rules, and the local rules are all seeing the same transaction, and the amount of foreign currency gain or loss is calculated against the same benchmark. So this is a really favorable change.
Yeah, and just as an aside, not related to 987 specifically, but one of the things that I think we have said, Rebecca, when we've been on these podcasts is make comments, and we try to encourage taxpayers to get involved in the process. I mean, we say it on a lot of these when we're covering proposed regs, and I love to highlight those examples of where, Treasury and the service listen and say, all right, and then they make the change.
Your comments matter.
Your comments matter. Now, sometimes, some comments matter, some comments, and now, like what we often see now in the preambles is that they're even addressing the comments and it's trying to explain why. There are a number of reasons for that. But I think the moral of the story is folks should comment on these proposed regulations, because and particularly if they are administratively burdensome and can't really understand the policy, those are particularly ripe for comment. Okay, so let's move on. Did they make any changes around the calculations themselves? And I'm specifically thinking about the QBU net value calculation and these remittance rules.
I think this follows a similar trend of the IRS and Treasury listening to taxpayer comments. So there's a number of places in the regulations where your starting point for the calculation is a tax basis balance sheet, which in many cases for your individual QBUs, you may not have. You may have a local tax package or a local controller records. And so the idea that you first had to create a tax basis balance sheet and then run your calculations was fairly burdensome. And as part of the final regs package, they introduced in a number of places, both for determining pre-transition gain or loss, as well as post-transition running your calculations year on year. They allow you to utilize a book-based balance sheet rather than a tax basis balance sheet. And this is, one hopes, going to help folks who don't have all the underlying available data and will ease administrative burden. In all cases, it might not necessarily be simpler, but it is an alternative that's available to taxpayers. And most importantly, if we think of tax as being largely data-driven, this allows you to match your calculation to the data that natively exists in your system, which is always going to be, if nothing else, more reliable.
I will note that for some true branches, that data may not be in the system either. This is one of the challenges that we've seen with Pillar 2 as well. But certainly, in my view, makes more sense to base that on book than tax principle.
At least it gives you two different choices, one of which may be easier to track down or determine.
Okay. And then what about remittance and these remittance proportion calculations?
A similar concept. So everything in 987 at the end of the day in determining how much gain or loss you recognized is based on looking at what the amount of your remittance was per year as a portion or percentage of your total assets, net of liabilities at the branch level. And so similarly, they allow you to do some of these calculations by reference to the percentage of book assets rather than tax basis assets. So it's, again, going to tie back to numbers that might be more accessible for certain taxpayers.
Okay. I want to move on to what I think is one of the more controversial aspects of these final regulations, and it's something referred to as the suspended loss rules. Tell us about those. Why are they so controversial? I know we have a de minimis exception, but just give us the background and a little bit of what your take on those.
Okay, you've asked for background, so I'm going to take you in the Wayback Machine.
Okay, please do.
So the year is 2000. We've just passed Y2K now. Sorry. So when we only had the 91 regs, a fundamental concern of the IRS and Treasury was the idea that foreign currency gain or loss was being what they would say is imputed on assets like plant and equipment and trucks that really don't inherently change in value based on fluctuations in foreign currency rates. And IRS and Treasury published a notice in 2000, Notice 2000-20, where they said, we are concerned that taxpayers are creating artificial losses because of the way 987 is calculated, that it's imputed on all these non-financial assets, and then you choose to make remittances or even make remittances and then immediately contribute back into the branch in a way that lacks economic substance, and that those transactions are problematic to us. And first, in this notice in 2000, they said, we're going to publish some regs with a different methodology, but we are concerned about this overstatement of losses. This is what led fundamentally to the FEAP method, so that foreign currency gain or loss is only imputed on monetary assets.
Yep.
When IRS and Treasury agreed to reintroduce a 91 method type calculation through the form of the current rate election, they said that the trade-off for adopting that methodology is going to be rules that suspend losses in certain circumstances. And so the most controversial of those is what's called the loss to the extent of gain rule. If you have a loss, it's not the only kind of suspended loss, but it's the most interesting, if you find any of this interesting. The amount of loss that you're permitted to take in any given year is, if you have made a current rate election, so you've got this larger pool of losses to take, is permitted only to the extent of gain in the same category, and not just that, but the same source, character, FTC basketing. It has to be the exact kind of gain so that you're not able to take 9A7 losses and offset other kinds of income. And when proposed, this was a year-by-year annual accounting convention concept. So you could have had years of gain recognition, you hit a year with a loss, and that loss is suspended until you recognize gain in the future. And taxpayers commented on this. And in response to comments, IRS and Treasury added a 3-year look-back period. And they said you're permitted to take a loss to the extent of gain in the same residual characterization in the current year and gains recognized in the prior 3 years. And so this is quite helpful for folks who have currency fluctuation.
Sure. Yeah.
Your pre-transition gain or loss is also a suspended loss. And so it gets carried forward, and its recognition is also potentially limited in certain circumstances.
And there's also a de minimis exception too.
This, again, a helpful rule. In the 06 and 16 regs, there was a concept, let me step back. We had deferral rules that are still preserved in the file regs today in a slightly different format, that if you had a branch that terminated but still existed in a different format, so things like you have a reorganization, so I have a different owner for a QBU, or I have a QBU where I liquidate its owner, so you've liquidated into the U.S., things like that. We have deferral rules that defer your gains and losses, and in some circumstances, only defer your losses. So in those rules, there was a de minimis rule, that if the amount of loss being deferred was small, we'll let you take it. They've imported a similar concept here with suspended losses, that if the amount of the loss is small, then you get to take it currently. You don't have to worry about this carry forward and the extent to which you have gain to offset it. It's a very small threshold, though. Yeah. Small is relative. It'd be big for me, but for a large corporation, maybe not.
Right. All right. So let's move on to character and source of Section 987 gain or loss. What did the final regs tell us about that?
Baseline, final regs are similar to the proposed regulations, where you determine as a starting point, 987 gain or loss is ordinary income, ordinary loss. In the hands of a U.S. person, like a U.S. company earning it directly, its source is determined by reference to the manner in which interest is allocated on a modified gross income basis. And so you have to look at the income that is being derived from the branch, similar for a foreign corporation as well. There are currently finalized regulations on source under the FTC rules that cross-reference back to now these final regulations as well. So it's all very consistent, and it's determined based on the income derived from the assets that are treated as assets of the QBU and on its books and records. So this concept of what is in the QBU's books and records from 989, kind of what are books and records of this taxable unit, becomes really important because it drives the interest allocation, and then that drives the sourcing. So completely consistent from 2023. The big change in the file reg package, they had proposed a rule that said if you have 987 gain or loss that's allocable to subpart F income, and that could be passive income, that could be foreign-based sales, foreign-based services income, they said we're going to treat it like it's foreign currency gain or loss in its own subpart F bucket.
Not by category.
Not by category.
Just sub F.
Yeah. And so it's kind of like foreign currency gain or loss on transactional exposures, so 988 exposures, if you don't qualify for business needs, is in its own little bucket. So they were treating 987 the same way. the problem was if I have a branch that, let's say, all I earned is foreign-based sales or foreign-based services income, I've now generated either a 987 loss that is in its own bucket that can't offset any other category of income, or I've generated gain where if I'm running losses in my business, they don't offset.
Yeah.
Either way, not a great result. And again, taxpayers comment, IRS and Treasury modified the rule and said you can match it based on the category of Subpart F from which it came.
Okay. All right, now we're going to cover a couple of the special rules. We're not going to cover the insurance companies in any detail, but I will note for those that are interested in that area that we have an alert with some of the specifics related to the insurance company. That'll be in the show notes, so you can check that out. But what I wanted to start with is partnerships and how these 987 rules apply to partnerships. So we were talking about QBUs as a branch. What about partnerships, and why or how is that different?
So this, I keep saying like this is a big deal, but these are all like really fundamental changes. So the rules have struggled with what to do with partnerships because they are both a juridical entity. Like I have a real legal entity that has separate personality, but also is flow through to its partners. And
I mean, one could argue, to interrupt, that disregarded entities could meet that same characterization, but you only have one owner.
Your pillar 2 is showing.
All right.
But the original approach back in 1991 was that
Before the check the box rules.
Before the check the box rules, to be fair. To be fair. So the original approach was it's a juridical entity. It is a per se QBU because it is a partnership and an entity for local purposes, and it can adopt its own functional currency. And because it is flow through to its owners, it is a branch or a QBU, and you pass through, you have some kind of gain or loss that should be taken into account. Fine. In the 06 regs, they adopted a pure aggregate approach. So each partner is treated as if it owned a pro rata slice of the assets and liabilities of the partnership, and you run your 987 calculation as if it's your own little branch, like it's your own little disregarded entity.
Right.
That attracted a lot of comments. The 16 regulations kind of adopted that only for related party partnerships. And then you had the 23 regs kind of preserved that and then wrote very complicated rules for partnerships and what happens when a partnership itself owns a branch below the partnership. There were a lot of comments that were submitted. And I think that a surprising number of types of taxpayers who are otherwise unaffected by these regs. So we think of this through the lens oftentimes of large multinational corporations. Asset managers, particularly like fund complexes who invest across multiple jurisdictions, these rules were incredibly meaningful. And whether you had foreign currency gain or loss in these structures or not, was something that was an issue really of first impression. The 2006 regs had a de minimis rule that said if you're less than a 5% owner, you just are kind of out of the scope of the regs. And the 23 regs didn't pick that up. So even if you owned a very small sliver of a partnership, you had this potential host of reporting obligations and foreign currency gain or loss. Lots of comments submitted, and IRS and Treasury reserved on the treatment of partnerships. They put out a new solicitation for comments under their proposed reg package, and they have reserved on the section of the definition of what's a qualified business unit, which is our starting point for all this analysis, on the treatment of partnerships. So preamble says you can kind of use a reasonable method, you can use aggregate, you can use entity, consistently applied for now as they consider future rules.
Right. And then what are the other special rules? And maybe if we can try to do this briefly, the net investment hedges. And I know this is one of like your areas, but any kind of highlights or lowlights with respect to how net investment hedge is treated?
Brand new rule. If you're hedging an investment into a qualified business unit, your GAAP or Treasury folks might see that as a net investment hedge of the equity investment into that entity. And it's properly identified, the gain or loss from that transaction is treated as adjusting your amount of 987 gain or loss. So instead of having discrete kind of foreign currency gain or loss, which would be either, for example, for a CFC, Subpart F or business needs, a very binary analysis, you match it to the categories of 987 gain or loss. This really solved a problem that otherwise could create some really material mismatches. And again, was the result of an industry group commenting that this was a place where there could be substantial mismatches.
This one makes a ton of sense, right? And some of those net investment hedges can be massive.
Unequivocally.
So, all right. So kind of moving from the final regulations, I want to talk about some of the tax accounting considerations and implications. And just, of course, tax accounting is always important for public companies. But now with the Pillar 2, right, which is based on book accounting implications. And so we talk about tax accounting within the books. So it's important for Pillar 2, also important for the CAMT as well. So maybe just to remind folks, we'll start with accounting for changes in the tax law. And I guess maybe the other thing before I throw this question, I think because these regs have been proposed for so long, many taxpayers have just kind of put some of this off. Maybe they've developed their own kind of methods, whatever. But like we're here now, we've got final rules. How do we account for these changes in the tax law?
Of course. And of course, I would be remiss if I didn't caveat that you've got two tax lawyers talking about tax accounting.
Right. Fair enough.
So take it with a grain of salt. As a starting point, if there's a change in tax law, an organization is responsible for accounting for the change in tax law in the quarter in which the change occurs, even if it has a deferred effective date. So the fact that these regulations were finalized in December of 2024 means that companies need to address them in some manner in the quarter or year end if they're a calendar year taxpayer that's ending now, even if those regulations don't apply until subsequent year.
So maybe some homework for companies to do as part of their year end to make sure that they get that right.
And it doesn't necessarily mean that they have things that they need to do differently. If you had been calculating 987 gain or loss on eligible methods, so you know what your unrealized 987 amounts are, maybe the amount of homework that you have to do isn't as significant.
Yes. Yeah. All right. So what about recognition of deferred taxes in the context of these 987 rules? And obviously this, again, big implications potentially for Pillar 2, CAMT, and for book income for that matter.
So I think there's a few different levers. The first is, I think you will care about whether it's a branch owned directly under the United States or whether it's owned under a CFC if you're a U.S. company. Because you're really going to care about, is this an item that will directly affect my income deduction gain or loss of my U.S. tax return, or is this something that is going into the computation of my Subpart F inclusion or
guilty?
If we stick with the U.S. for a second, the second thing I probably care a lot about is whether I anticipate making remittances from the branch, or to flip it into financial statement language, whether I've asserted that I am permanently reinvesting in this entity such that I don't expect to have remittances. Because if I've made a permanent reinvestment assertion, perhaps those items that relate to that entity, because they're never coming back,
right,
I don't necessarily book deferreds on those. Within the realms of CFCs, now this gets more complicated.
Yeah, it does.
Because if I divide the world, roughly speaking, into Subpart F and non-high tax Subpart F and guilty, you have a limited population of folks who necessarily book deferred items on guilty.
For sure.
And might view those as period costs. So there's a whole bunch of different levers that are going to influence whether there are items that you need to book as a result of transition. The other thing that's worth pointing out is that you also have to think about whether you've made any elections that might crystallize items that are then taken into account in the future. One of the levers around 987 gain or loss is that it's only recognized at the time of remittance, which is something that in general companies control the timing of when a remittance or a distribution is made by a branch. There is an election that's part of the transition rules that says for your pre-transition gain or loss, you can elect to amortize it over a 10-year period. And you take it 1/10 a year. And so as a company, you'd want to assess whether if you are going to make that election, and if you've made that election, does that mean you now have an amount that is crystallized that has a different impact on whether you have to book deferreds? And then the final item is, for many companies, this isn't the first time we've had final regs. It's just the first time we've gotten past the effective date for such regs.
Right. Yeah.
So in 2016, we had regulations under 987 that were finalized, and that with this FEAP method being the only method. And so some companies made adjustments because it affects, basically you have a book to tax difference on the basis of assets that are non-monetary assets. and that might have generated deferred items. Because those regulations are now no longer effective, they've been replaced by the 2024 final regulations. Companies need to assess whether those are items that need to be adjusted or pulled down because they're no longer relevant.
All right, so let's move to the proposed regs, where I think the issue there was something referred to as the recurring transfer group election. So what is that? And we can then talk a little bit about applicability dates.
So I sound really positive about the final regs and the proposed regs. So IRS and Treasury received a lot of comments on the fact that in a world where we have disregarded entities, the volume of disregarded transactions between entities is huge. And those could be disregarded inventory sales, services payments, royalties, that this is sort of a hallmark of the current tax system post check the box rules. And there's a huge administrative burden that goes into if you have to account for every single transaction on the spot rate on which the transfer is made. That is not a data point that's retained for GAAP or any other purpose. And if the volume of those transactions is high, it's incredibly burdensome to track. And so they provided an election that allows you to use the average rate for the year as a simplifying assumption to calculate sort of the contribution or remittance as appropriate. It's limited to things that are non-monetary transactions, so disregarded services, royalties, rental payments, and similar. And they solicit comments on whether they can extend it to other kinds of like disregarded loans and interest payments and disregarded cash transfers.
So listeners out there, comment. And when would these rules potentially apply?
They're proposed with a prospective effective date. But again, it's going to really depend on whether they're finalized.
All right. So last question for you here. We spent all this time going through all these new final regulations. You may have read that we have a change of administration here.
Really?
Yeah.
Oh.
New president in the U.S. How could that change of administration potentially impact this? Because just to remind listeners, particularly some of our non-U.S. listeners, if they're still listening at this point, that these rules were finalized and proposed by the Biden administration. We now have the Trump administration that has come in. And this isn't unique to the Biden to Trump trend. I mean, this is an issue every time we have a change of administration. And the IRS and the Treasury are part of the executive branch. And so there's always this change. You know, tax law tends to be, in my view, sometimes, and particularly at this technical level, sort of less partisan than maybe other areas of that we see. But any ending thoughts here on what the change of administration could mean for either these proposed or final rules?
Obviously, not in a position to make any kind of prediction, but I think some history is relevant here. So I mentioned that there were previously regulations that were finalized and then never became effective, were deferred. Those regulations were finalized in 2016. And one of the choices that the first Trump administration made was to, by executive order, sort of defer the effective date of certain regulations and then ultimately to put them out for additional study. And 987 was one of those reg packages. And the Trump administration came back as part of the report out in this executive order and said, we think that these regulations need changes. We need, for example, taxpayers need the option of utilizing something that looks like the 91 regs and other administrative changes to make them more administrable. So the reg package that we see proposed in 23 and finalized in 24 reflects a lot of the recommendations that were made during the time of the first Trump administration. Now, that doesn't mean that necessarily views will remain consistent, but I think it is one of those reg packages that, IRS and Treasury personnel might view as being fairly bipartisan because it reflects feedback from multiple administrations, including the current administration.
Yeah, and for those taxpayers out there hoping, well, maybe this just goes away, I think that was one of the reasons we want to cover the accounting point, is that for calendar year taxpayers, this was enacted in 2024. You may not have the ability to sort of wait and see what's going to happen for financial statement accounting purposes, so nothing else.
I think that's fair.
Okay. All right, Rebecca, always a pleasure having you on. Fun going through this particular area. I always learn so much when you join these podcasts, so thank you very much for joining.
Thanks so much.
Thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Rebecca Lee, International Tax Principal in PwC's Washington National Tax Services Practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.